Hi, good afternoon. I'm Damon Southward, Chief Market Strategist here at Briefing.com, and also a poster under the scalp and yield tickers. Thanks for attending the webinar. Joining me today are Brett Manning, who goes by the handle ChartTrader, Jim Bush, Growth Trader, and Scott Smith, aka Blue Chip Trader. I've been trading for approximately 15 years, primarily using a scalping style. However, the past 2 to 3 years, I've delved a lot more into swing trading, and especially on the yield side. First off, I'm going to talk to you about how to set up your site. One of the complaints that we've gotten over time is that there's just so much information coming at you. And I want to make sure that you have your site, your browsers, and your site customized in order to gain best use of the Briefing Trader experience. Okay, so we're going to start off on dual and play. You know, a lot of people probably use single and play. I personally prefer dual and play because it allows me to customize my filters. So you'll see here that you have two screens that basically show the exact same thing. They do show the exact same thing. What I would suggest if you're dedicating a full monitor to Briefing.com is to run dual and play and to separate the two sides by using the custom filters. So for example, if you're focused on trading calls, I would check the trading calls and then focus on the type of style that you're using or paying attention to. General trading calls tends to be a catch-all for general comments that our traders are making about stocks. They may incorporate hints of a trading call, but more kind of watch list types of comments. So I don't always have general trading calls checked because most of the traders will put information under that. So the other categories are pretty self-explanatory: intraday trades, scalp trades, swing trades. So for example, if you go to just, well, I'll go scalp trade since I post under Scalp Trader. You'll see that this narrows down the information to just scalp trades. So if you like swing trades, you can go there, and you'll see our swing trading ideas, primarily from Commodities Trader, Blue Chip Trader. Beta Trader will also post there. Then intraday trades, we'll see Blue X Chart, Beta X. Now, if there are other categories that you pay attention to, so for example, I always have all trading calls checked. Then I like to know top events because if there's something breaking coming across, it's easy for it to scroll across your screen here because there's so many comments flowing through the screen. I also pay attention to rumors because I trade rumors. And those are the primary ones I'll have running during the day. So you'll see here, by having the custom filter applied, I can see just the information that I'm paying attention to on an intraday basis. Whereas over here, this is everything flowing through the screen. Now, another benefit, another feature of the site is that you can change the view to, say, from a full view to a summary view or a headline view. So for the benefit of getting more information on the screen, you can go to a headline view, and then in order to see the full comment under the headline view, simply hover over the time or over the reading pane. So as you can see, you can probably fit about 15 to 20 stories here, versus if you're running a full view, you can only fit 3.5. Okay, for individuals who have a problem with screen space and they can't dedicate a whole monitor to just Briefing.com and you're running multiple services, you can press this pop-out window here, and it's a fly-out window, and you can customize the page to fit your size requirements. So you can shrink it if you like, and then change the display to, say, like a headline display, fit tons of information on the page, and you can open up several of these if you like. So if you want to have one that just focuses on, say, everything, and then open another one that focuses just on trading calls, for example. You can select the filter, uncheck all comments, go trading calls, and then you can run multiple screens here. And you can put them wherever you want on your monitor. Another area that I want to make sure you're aware of, we post our style comments, the trader style guide comments, under the ticker STYLE. And we updated these recently. So if you're curious about each person's trading style and their risk and just their general approach, this is a good place to go. You can print it out or simply go there every quarter or so, because we try to update them every quarter to reflect market conditions. So you'll see here, blue chip, myself, scalp, beta, chart, commodities trader have all updated their style guides. Chart will be speaking towards the end of the webinar, and he wanted me to point out that he did a webinar on his specific trading style last year that is pretty detailed. It's about an hour long. If you want to access that, go into the search with the style ticker, and you can simply press the link here, click on the link, and it will take you to that webinar. You'll also receive an email with a link to the webinar after probably tomorrow or the next day. All right, so we're going to jump back into the presentation, and Jim Bush is going to walk you through his specific trading style.
Hi there. My name is Jim Bush. I'm a senior analyst here at Briefing. I manage a number of the idea generation systems and also post commentary and trades under the Growth Trader name. My personal style of trading is mostly that of a position trader, which means that I like to hold stocks for several weeks to several months, basically as long as the idea is working. My primary tool for selecting stocks is relative strength. So I'm looking for stocks that are outperforming the market on an intermediate term basis. I also use fundamental analysis. So for the most part, my trading universe consists of stocks that have good momentum and identifiable fundamental catalysts. So why do I use relative strength as one of my primary tools? Basically, and most importantly, numerous studies have shown that 6-month relative strength is the best single indicator for predicting future price outperformance. So it's effective. Another thing which is nice about it is that it can be used in a range of different trading and investing strategies. Briefing Trader offers 3 proprietary relative strength-based systems: emerging growth, emerging value, and liquid momentum. Some of you may be familiar with these already, but I'll give you a brief overview of each and then go into how I incorporate them into my trading style. Emerging growth is our quantitative ranking system that screens for small and mid-cap growth stocks that have the potential to become market leaders. What it does is it pairs superior relative strength with strong fundamental growth characteristics. It's actually suitable for either day traders or position traders, swing traders too. Actually, it's depending on your time frame. A lot of people can trade these stocks. One of the frequent questions we get with emerging growth is whether it's any good at identifying these new market leaders. This briefly is our annual performance table. Just shows for each year since inception some of the top 20 gainers for each year. So it's been pretty effective at identifying these. So lots of opportunities there for small and mid-cap, high momentum stocks. My strategy with emerging growth, first, every Monday I review the new buy list, particularly the new additions. Once I feel like I understand the fundamental story behind each one, then I'll import the components into my charting software and review the charts for promising technical patterns. I really believe that the best trading candidates combine, compelling fundamental stories and good technicals. So for me, I need to see both of them. I'm not going to, say, trade small biotech with great relative strength but no fundamentals, or I'm not going to trade something with great fundamentals but the technicals are suspect. So here would be an example. And I'm using stamps.com because, number one, it was a very good performer for us last year. And number two, because the chart looks like a lot of charts that we're seeing right now. You tend to see a lot of these types of charts, right near the tail end of earnings season. So with stamps.com, this is one of my favorite types of names because this one was very under the radar. It was kind of a left for dead stock that no one was watching. And in late July of last year, they reported just out of the blue, just a huge quarter, a real turnaround quarter. I remember posting a comment on the site after hours pointing it out how unusual that is. And the stock ran 30% the next 2 days and looked very extended. So typically when I see charts like this, either with stamps.com a year ago or with a lot of the ones today, I start waiting for a pullback. Stamps.com, you especially wanted to wait for a pullback because that happened right before the market crashed in August. But what was unusual here is that not only did Stamps have a great quarter, but what I'm watching for during the pullback is for it to prove its relative strength. So in other words, it's not just the gap up that's important in the move immediately after earnings, but how it behaves as it pulls back from that initial move. With Stamps, you can see that it held the gap on a closing basis, and it found support at the 50 EMA, basically to the penny, and stabilized. And that told me that, when the market turns for the better, this one's going to run. And again, this is something that right now I would be on the watch for as well if we ever get a pullback. So this is how Stamps worked out. This is the time that we were referring to right there. Stamps actually went on to make a really nice run after that. So again, it's not only important to prove the relative strength right after the catalyst, but especially on the pullback that comes after it. So those are the types of names I look for in emerging growth. Here's another one that's actually very recent right now during this earnings season that I'm watching for. Constant Contact, very similar type of name, kind of left for dead. Business was so-so for many years. They started to grow again, had a really good quarter recently, and now I'm waiting for it to prove its relative strength. If we do pull back, if we see a market pullback, I want to see it hold key technical levels. That would convince me that, once we stabilize, this one's going to run higher. So this is another one that I'll probably be posting on in the future under the Growth Trader name. Emerging value is a little bit different. This is our quantitative ranking system that screens for stocks that combine attractive valuations and positive money flows while avoiding value traps. It pairs superior relative strength with low valuations and high yields. I would say this one's suitable more for position traders. It's brand new. It launched on January 25th. And the #1 ranked stock on that day was Seagate. And I'm going to just sort of walk you through an example there of how, how I use emerging value for my trading style. When Seagate appeared on January 25th, this is what it looked like. It had fantastic relative strength, and I remember some of the guys in here commenting, or one in particular who said, this is a name that had run more than 100% off the October low, and this is going on a value list. Well, what was key here is that it had run, or it had doubled off that October low, but it was still dirt cheap. It was an extremely cheap stock. So you had two different things going for it at the time: high relative strength and a very cheap valuation. So really all this one was waiting for was a fundamental catalyst to make it go higher again. And it turns out that their earnings report, and actually even the commentary from the call, was even more important than the report itself. But this one, once it got that fundamental catalyst, went from dirt cheap to reasonably valued in just a matter of days. And it's still one of the leading stocks here. So this is how I use emerging value, which is basically similar to how I approach emerging growth. Review the new additions, check the charts, etc. And then from a trading perspective, I'm looking for a stock that combines, the really strong relative strength paired with really cheap valuation. And then what I look for, or what I wait for, is a positive catalyst that can make that break higher, because what you have to understand with these emerging value stocks is that even though they've run quite a bit in order to qualify for having a high relative strength rank, they're still very, very cheap for the most part. So these can run a lot farther than some people might expect simply by looking at the chart, just to get to a market multiple. So again, these are probably more appropriate for position traders, but you can find some good ideas there. And finally, liquid momentum. This is the third one. It's our quantitative system that produces a weekly focus list of the top 50 stocks in the market with the best swing trading characteristics, which we define as strong momentum or the presence of a trend. And we use relative strength to define those. Price volatility, which what we use to find that is a high average true range divided by price ratio. And good liquidity, so trades a million shares a day on average. With that, I'm actually going to leave it here, because Scott Smith, who's also known as Blue Chip Trader, is the lead analyst for liquid momentum, and I'm sure he'll have more to say about it when he discusses his trading strategies. Scott?
Thanks, Jim. Okay, my name is Scott Smith. I post a lot of trading ideas under the Blue Chip Trader ticker, also Blue X on the site. And in the next few minutes, I'm just going to walk through a couple slides explaining how I basically view and analyze the market on a day-to-day basis. For those of you that don't know, I'm a combination of a day and swing trader. The bottom line here is if a trade is not working, I get out. I don't like to carry losses home overnight. I don't want to be worried about it. If the trade is working in my favor, then I'm definitely going to carry something overnight, and hopefully for a couple more days as the trend works in my favor. I usually want as little risk as possible overnight as well as on my trades. However, I also realize I'm not going to be able to pick the tops and bottoms of a lot of stocks, so I usually am pretty lenient with my stops. I usually give about at least a 1-to-1 ratio. In most cases, I give about $1. I usually start off with $1 risk. Once I make $1, I start trimming, I start taking partial profits. I make $2, I take a little bit more off. And then by then I usually have maybe a third or a quarter position left to carry over as a swing, hopefully for multiple points thereafter. On a nightly basis, I do write a couple columns. I do have the TA page scans that I have to go through and post. The liquid momentum focus list is also a list that I have to update and comment on. And I also write the swing trader column 2 or 3 times a week as well to get the general market sentiment view and market trend views as well. Those are basically the 3 pages where I get most of my trading ideas from. They're based upon ETFs, sector ETFs, as well as stocks with really high momentum, high volume, as well as high ATR. So you're going to get stocks that are going to move. You're not going to find Bank of America, GE, Johnson & Johnson's, McDonald's. You're going to find more of the faster moving momentum names, you know, like the F5s, the Apples, the Baidus, the Netflixes, IBMs, etc. I do trade ETFs, but mostly from the short side. It's just a preference. It seems like every time it gets short a stock, there's always an analyst that's upgrading it and squeezing me out of the position, whereas the ETFs seem to be a little bit more better as a hedge in my experience. So the nightly and morning preparation that I go through, the first thing that I always do is I look for the, I calculate the S&P pivot points. I also take the day's range and I calculate the Fibonacci retracements, and I also look for just key price levels. Just some place where the buyers looked like they stepped in, you know, intraday, or sellers looked like they started taking control. I also look through a series of different sectors and just the markets in general, just to get general context. Are we bullish? Are we bearish? Are we trending in a certain way? Are we sideways range? What levels do I have to pay attention to? I go through the TA page scans, like I said. I also go through the liquid momentum focus list, and I'm just, you know, I go real fast through all these charts. I really try not to get too complicated. I like my patterns to be just jump off the page at me and be really clean and recognizable. If I can't see anything at a trade, or I don't like the way it's set up, or the pattern's all sloppy, I just move on. There's always another opportunity somewhere else. At the end here, I posted a little comment. It's a quote. I'm not sure who said it. I think it was Ben Franklin. He basically said, failing to prepare is preparing to fail. And you should just definitely have a list of stocks that you want to trade and areas that you want to get involved in when the market opens. You want to do as little thinking as possible once the stock market opens. You want to have some sort of agenda, a plan A and a plan B, to just go in. You don't want to think about how many shares of a stock of $150 stock you're going to buy, or how many shares of a $25 stock you're going to buy. You don't want to think about spending too much time on where your stop losses are. You should have all that money management and risk management well in advance, as well as the stocks that you're kind of leaning towards or focusing on. Once the market opens, I break it down into 4 different segments of the day: opening ranges, the first hour ranges, midday ranges, and afternoon ranges. For me, I try not to overtrade, and I try to do most of my trading within the first 2 hours of the day, based upon the opening range and first hour range that developments that I see. Midday ranges I try to really avoid as much as possible, unless there's actually some sort of strong upward or downward move. And afternoon ranges, that's another one. I'd much rather be taking profits and determining if I have to carry an overnight position at that point. I don't want to be initiating any new trades really that late in the day. This example here, this is a chart going back on February 7th to early February 9th, and it just basically highlights those ranges that I'm looking at. And just starting over here on February 7th, you can see the opening range. It's basically, I hate to label it as a specific time frame, like a 5 or 15-minute or 30-minute time frame, but I'm just looking for turns. I'm looking for where did buyers step in or where did sellers step in, and that's going to determine the opening range highs and lows. Come the first hour mark, which is right around here, or actually probably reversed up there, but this became the first hour low. And this is a good place to usually put stop orders, if you're long, and vice versa if it's first hour high. Once price trades back up through a significant range, it usually shows as a shift in supply and demand. So in this case here, you can see that the buyers stepped in off opening weakness, took it right up through the opening range, suggesting that the buyers were in control. From there on out, I'm not really going to want to be too focused on the short side, and I'm going to be more focusing on buying dips and certain pullbacks. The midday range, you can see, gets really sloppy, and then towards the afternoon, they kind of lifted prices higher into the close. On the next day, you had the opening range where price turned, and it found buyers, it found sellers. They tried to break it out higher, and then right around here was the first hour or so, and the sellers came through. They took it right back through the opening range. It's a balance of control. It's a shift of control, shift of power. And you can see sellers just took it right through the opening range. They took out this morning range low. They took out the mid-range low, and the selling just started to accelerate. Now, taken in context of the uptrend that we've been in, you had to also anticipate that there's going to be some buyers stepping up on extreme weakness. In this case, you can actually see this is where RSI 14 on this 5-minute chart was starting to get oversold. There was a pivot level right around here. There's also a 50% retracement based off the prior day's range. So you knew that 1342, 1343 was a good area to either start considering buying or at least covering your shorts if you got short based upon the opening reversal. Sure enough, we had a little rally come up. The midday range, it gets kind of sloppy again, but then in the afternoon, the buyers started lifting it above the midday range for another strong close. Then the following day, you could see prices pushed higher. You had a little turn here. They failed to take it up through the opening range high, and then they started selling stocks pretty hard back through the midday range midday range of the prior day. And then, again, the first hour low, right around the 10:30 Eastern Time, 9:30 Central. There's usually turning points at these first hour marks, and daily R1 was in effect down here, as well as a 62% retracement of the prior day's range. And sure enough, buyers came in, started defending. They took it back up through the opening range high, and I believe it went up to 1356 that day, or 55 that day. General rules, again, using those times of day ranges. If it's above a range, the buyers are in control. If it's below one of those ranges, the sellers are in control. Reversals through the range represent a shift in control. and you should also just monitor the prior day's ranges as well. The midday ranges for me from the prior day is usually a pretty key indicator to determine whether there's more people trapped in a losing position, long or short side. Obviously, you want to also look at the confluence of pivot levels, Fibonacci retracements, and overbought, oversold indicators to try to time everything a little bit better with your entries. For those of you that don't know where the TA page scans are, it's under the investing and trading column, and it's under TA page scans. The liquid momentum is right above it. And if you're interested in the swing trader column, I believe it's under the perspective heading. Here you're going to see a number of specific scans that I've created over the years. They're not these black box systematic trades that you just run out and buy or short the next day at the opening. It doesn't work that way at all. It's just designed to shorten your nightly homework that you do or your morning homework that you do to find good trading opportunities. These are high momentum, high liquidity names, and you can just see that they're pretty well defined, whether it's a 3-day correction in an uptrend or a 3-day correction in a downtrend. It's inside day. It could be a really narrow range. It could be a stock that's very overbought compared to where it's been trading the last 5 days. It could be a breakout or a breakdown, or it could just be just sitting along a key moving average, like a 20, 50, or 200-day moving average. It doesn't take that long to go through these charts. It may look like a lot initially, but really you can just look at the ones that just capture your attention, the names you're familiar with, and if you look at the chart, you should be able to identify exactly what the setup is telling you what it's identified, what the computer's identified for you. If you can't see it, move on. There's plenty of other opportunities. I am a very visual person, so I'm going to show just a few more charts of recent examples, just so you can get a better feel for the style that I have. Again, I start off with all my trades as a day trade, and as long as it's winning, I'm going to try to turn it into a swing for as many days as I can. In this case, I had National Oil Well. This showed up as a pullback long candidate for February 2nd, and I believe they reported earnings. So just looking at this chart, it corrected 3 days. It's in context of an uptrend based upon the 20-day moving average, and essentially I'm going to be looking for a buying opportunity somewhere around the 75.50, 76 area on some sort of sign of strength. It had actually reported earnings that morning after it showed up on the scan, and buyers stepped in down here at 73.50. They took it above the previous day's highs around 75.25, and they launched it up to 76.50. You could have gotten in above the previous day's highs, but I was waiting for some sort of pullback to jump aboard. And I believe when it came around 76 and it held this area here, I recommended taking half size as price began to rally out of it. I added more on this first hour opening range breakout around 76.60-ish area. And before midday, we caught 1 point, which to me, that's a great trade. And then you just move your balance stop somewhere up to break even, just in case it comes back in. So the worst case scenario, you have some sort of scratch on the trade. The stock wound up closing around 77, so it was worthy in my eyes as a hold overnight, especially since it had this nice rally. It closed at 77, so it was rallying out of this little bullish flag pullback pattern. So it was worth holding a little bit overnight. You could see it actually gapped up the next day to about 79. You could have trimmed more profits off if you had some size to do so. It got to 80. I think that's where I recommended taking most of the remaining balance off. And now we're still holding it. I believe it broke out to about 84.50 just this afternoon, and we have a nice little trailing stop somewhere around 82, 82.25. So the total gain on this, back from our 75, 76 entry point, has been close to about $8 so far. Granted, it's smaller shares. It's only about a quarter of size position left, but I'll take that any day of the week. Another example was Green Mountain Coffee that we had. It gapped up on earnings in early February, and it started pulling back, showing up on the pullback long candidate from the TA page scans. And aggressive traders should start, usually when a stock gaps up on earnings, that's a pretty solid support area, and you want to start paying attention to those levels. And more aggressive traders probably could have got in early around 62, 63, and then the swing trade would probably come in around 65, 66. On that day, when it showed up, it opened up at 64, pulled back to near the previous day's close around 63, and I recommended taking about a half a size position, risking about a dollar and a half, knowing that that gap was just below. When it broke out above the opening range highs, I added the other half. So we had about an average price around mid-63s or so. Price kind of consolidated and then just started rallying out of this first hour consolidation pattern. Took out the previous day's high for a 1-point gain, take partial off, maybe a half a position or a third. Consolidated really nice during the midday range, started moving higher. The next day, it started rallying even harder for a 2-point gain, which we took a partial in. And the balance, I believe, yesterday hit somewhere around 69, which was a 5-point gain for us. And then it started reversing in the afternoon below where we took our second partial around 66.50, which means you should just get out of it. You don't even want to hang on to the balance by that point. Deckers, I did a webinar on the TA page scans in detail last Thursday, and this stock was given as an example as an inside day. It actually showed up for 2 days in a row in the scans as an inside day. And the one thing I pointed out was that it's great for a day trade. As it broke out above 87, 75, 88, it rallied up about $1.50, $1.75 or so for a nice day trade. But then it came flying back in and closed negative. This type of failure is, I've seen this multiple times, where it just says the stock's not ready to go. And if the stock comes out the lower end of this range, this inside day range, you almost want to take a short because it usually winds up significantly lower the next few days. And sure enough, it opened a little lower. I didn't get the exact entry below the 2-day, 3-day lows here, somewhere around the mid-84 area. I suggested that we get short, and we wrote it down for a nice little swing trade for about 5 points down to 79 area. Overall, I try to avoid over-trading as much as possible, even though I do look to make probably somewhere in the vicinity of 2 to 3 trades a day, depending on how I see the setups. I'm always taking a partial profit whenever, if my risk is $1, I'm going to definitely take something off at $1. It's the risk to reward ratio. And I'm also going to adjust my balance stops usually closer to break even, just in case everything reverses. I don't hold losing trades overnight unless they're hedged. I know I'm not going to be picking the tops and bottoms in all my positions, so I definitely like to give them a lot more wiggle room than most people are willing to accept. If you can't give the stock a lot of wiggle room based upon the patterns that I see or the patterns that you see, my recommendation would be to trade smaller. The smaller you are, the more tolerable you are, the more risk tolerance you usually have. If you really like a chart, you should probably you just don't, even if you think it's going to go up 10 points, you're better off not just betting big, trying to hit that home run. You're much better off just sticking to your money management levels and just taking a normal size position and just properly executing the plan that you've had in place. You don't want to. This isn't a game about trying to who gets rich the fastest and the quickest. If you're really going to do this for a living, you want to be as consistent as possible, and sometimes that means trading smaller. And you should just at least try it for a little while, and you'll probably realize that trading smaller is a solution. Trading small and trading less is probably a solution to a lot of problems. Like I said down here, you also don't want to stray too far away from any sort of nightly homework you do or initial plan that you have. Prepare each night for a bearish scenario, prepare each night for a bullish scenario. Identify your levels. What I'm going to do is I do post commentary throughout the day as well as trading ideas. Hopefully you can just pull up a chart and see exactly what I'm looking at. It's tough to kind of post a chart and post analysis real quick while everything's moving. But for the general part, a lot of us on this site are going to try to keep everyone at least on the right side of the market and hopefully in the right stocks to make as much money as possible. If you have any questions, you can contact me at swingtrader@briefing.com. And now I'm going to switch it back to Damon.
All right, I just wanted to remind you that we're going to have a Q&A at the end of this session, so feel free to go ahead and start sending questions into the text box. And Brett Manning is up next. I'm going to drive with him.
Hey guys, my name is Brett Manning. You know me on the chart know me on the site as ChartTrader, and I'm actually a little bit sick right now, so hopefully I'm coming through enough. As you've probably seen for the last few years, for those of you who've been with us for a while, I trade mostly top-down macro positions. If you're on trial, you can see that pretty much I've been focusing mostly on things like crude oil, gold, the euro, etc., and sometimes, like today, quite a bit in the NASDAQ 100, even though on the wrong side of it. So it's quite a tape. But my setups are generally based on using chart patterns, sentiment data, and inferences from the tape to try and find markets that are imbalanced in terms of what I call strong hands and weak hands. And I'm sure you've heard those terms before, but I get a really precise kind of way of dealing with those concepts. And I don't really have time to go much into that right now, but I just want to point you to my webinar that I did last year. Damon already kind of discussed this at the beginning. And we're going to send a link in the follow-up email that you can click on, and you can see that. Scott did a really nice job of going through in depth in his trading style there and in his webinar last week. And I take a kind of similar approach and go through about an hour of detailed setups and concepts. So if you want to get a feel for what it is I'm looking at when I'm taking a setup, just go ahead and check that webinar out. But today, what I do have time for is focusing on how I monitor big markets across the asset spectrum to try and get hints about what's going on in terms of how these markets are fitting together. And I kind of think of this as something like an intermarket relationship jigsaw puzzle. And can you guys switch the slide, please? And when I am trading, I'm monitoring 5 different screens of data, and one of them looks like what you should see right now. And you can see I'm generally watching the S&P 500, the NASDAQ 100, crude oil, gold. Now I've got the financials in that box, then the euro, the yen, and the 10-year treasuries. And I'm not sure that a lot of you guys are monitoring these things, and I just kind of want to make the point, especially in the sort of market that we've got right now, and we've had actually for the last few years, ultra important to keep an eye on these things because a lot of things are coming really pretty much down the pipe, top down. And if you're somebody who's basically just used to trading an individual stock and doing it on stock-specific news, then a lot of times you're going to see a pattern shift on you and just come steamrolling across, and it's going to be led by something like a break in the euro. And there's going to be that delay, and the euro is going to start to break, and then all of a sudden you're going to see something like, Freeport or Caterpillar or something just start to break with it. Or the financials, the banks just start to go. And so it's really important, I think, to keep just one screen up where you're basically watching this jigsaw puzzle just so you kind of have this sense of what the top-down forces are and how they're fitting together. And you want to go ahead and switch it to the next slide?
Okay.
Yeah, I think it's real important to track these relationships, as I've just said, because you can get kind of a jump on the inflection points. And there's tons of examples every day of how this is happening right now. And if you're not watching it, then you're missing those key clues. But I think it's also important to understand the way these markets fit together and interrelate. It shifts through time. And the logic is based on pretty much 2 forces. One thing I call market habit, and the other is a financial factor that's kind of involved in how leverage is put to use. Next slide, please. So the big obvious example of the financial force determining these relationships between these markets, between stocks and commodities and currencies, for the last few years, the big example is this liquidity function that's been going on. And that has not always been the case. And if you're new to trading, markets don't always act like this. You don't always have a situation where the dollar's running inverse to everything just about every day. If you look back to the 1990s, the dollar moved with stocks pretty much the whole time. And when the dollar pulled back, stocks pulled back, and vice versa. And now we've got a situation where you've got 0% interest rates, and you've got multiple quantitative easings. And that's pretty much massively increased the total available leveraged buying power that's in the financial system right now. So every time they go ahead and push that button a little bit further, add more liquidity, it may not be going into the real economy all that much. Eventually it probably will, but what it is going into is just buying power on Wall Street, and these hedge funds are just hooked into it. And so you're going to see the dollar move inverse to everything because essentially when you're margining up, the margin is the dollar debt. And so, taking on that margin is essentially a short position in the dollar, and you're using it to fund an increased capital ratio in your exposure to whatever it is you're trading. So as you take those positions off, you clear your books, you're going to if everybody's doing it, they're going to take that market down. You're going to see the dollar rip in the opposite direction as everybody feeds back out of that debt. So that's pretty much the big obvious example. And we saw for a while what was called the yen carry trade, and then it turned into what I called the proliferated yen carry trade, where you'd have everybody doing it off of yen leverage, because for a while there, the dollar wasn't at 0%, right? It was a few years ago, the dollar was at, operating at 3%, but the yen was sitting there at 0% for a couple decades just about, and they were doing the quantitative easing already. So it was what we see now with the dollar, only with the yen. And you'd have a situation where the yen would start to rally, and all of a sudden it becomes a lot more expensive to repay that debt to get out of those positions, and it becomes something like a downside squeeze in risk assets. So you saw it with the yen. Now we see it with the dollar. And when you've got everything going on in Europe right now, you've got, obviously, the euro is, by definition, inverse to the dollar. That just exacerbates the relationship even more. So, of course, we went through entire last fall with a situation where everything that was a risk position, if it was gold, if it was crude oil, if it was stocks, it didn't matter. Everything was basically running with the euro. And it was kind of the accumulation of both of those forces. Then the other aspect is market habit. And this used to be, let's say 10 years ago, just about traders kind of getting used to the fact that certain things move together, and when there was a strong relationship going, traders would just kind of reinforce it by everybody acting on it. But now that's gotten those programmed in. And when they see the euro break, they turn and they just start shorting these things really hard. So that just kind of reinforces the fact that I think it's really important, even if you really don't trade these large markets the way that I do, if you're just trading even small cap stocks, just keep an eye on this sort of thing. And ETFs are another way that this sort of relationship set is augmented, because everybody has a really easy way. Even at home, the retail trader has a really easy way to start trading really large markets, even if they're not used to futures markets. So suddenly you've got easier access into the same kind of top-down trading, and it becomes one more factor that's this kind of self-reinforcing function. Next slide, please. Right now, the way that I'm trading things, I think we still have the liquidity-dominated function, so you still have to key on the dollar and the euro. But I want to point out that in late December, we did start to see things shift, and they're still responding in much the same way, but there's a lot of times, and we've seen it over recent days, obviously, with the euro starting to move lower and stocks just continuing to power higher, that this correlation has receded a little bit. And you can also pick up hints that way when you're watching these sorts of things. If you start to see something that's been an established correlation, and you know that there are these quant funds and these individual traders keying off the established relationship, you can make one of what I talk about a lot in my webinar, one of these inferential reasoning moments, and realize that you're in a situation where if the euro dives and stocks hold up, you can just immediately infer that you've got a lot of weak hands short stocks that are doing it on the basis of the existing relationship with the euro. So the euro dumps, stocks try to dump, but they hold, and then they start to leak higher. You can pretty much infer that you're going to get the squeeze. And that's kind of inferential logic that I'm talking about. And once again, something else that you can pick up by monitoring these relationships. And as I post during the day, you'll see me make a lot of little comments that don't really have to do with a particular position that I have on, but I'm trying to say, notice that the euro is doing this, or notice that crude oil is doing that. And it'll usually refer back to something that I've talked about either that morning or the previous morning or sometime that week in one of my columns, where I'm pointing out a potential relationship and what it may mean for stocks. Because usually I'm kind of making an inference that will, in the end, have something to do with what the S&P is going to do. And so I update my thoughts through the day, kind of making reference to these relationships. And of course, if you have any questions about them, you can email me or just cover it in this webinar. But each morning, in my column, the ETF Daily Notes, I basically go over the landscape of what I see to be the key things going on right now in terms of the relationships, in terms of what the individual setups are for these large markets, and then in terms of how the correlations are playing out. And then I also cover it once every couple weeks in a bigger overview chart book column. And of course, you can contact me anytime and ask anything you want for the rest of this. Thanks a lot.
Okay, thanks, Brett. So we have some questions here, and feel free to submit them as we answer the questions that are presented currently. Okay, first question is, what is the symbol used for emerging value? And the ticker for that is value, V-A-L-U-E. So that was an easy one. Could Scott give an example of hedging a position he wants to keep overnight?
Sure. I didn't do it today. I don't know if you were tracking my trades today, but I did carry a Freeport McNamara, and I bought the stock this morning on an opening reversal. I was pretty bullish on gold stocks. They've been destroyed the last 5 or 6 days. The dollar's been rallying, kind of gapped up this morning. I suspected some sort of bouncing on the gold sector and a dollar reversal a little bit. So Freeport McNamara is just one of my go-to stocks to trade. And it did an opening reversal, and it kind of just started buying it as it went positive today. And we caught about $1.50 on it, I believe, and held it overnight, just a half a position. The market's very overbought right now. I was tempted to put on a short spider position, SPY or UPRO position, just against that. Just because who knows if the dollar continues higher tomorrow, or gold stocks just get slaughtered again. So that would have been one of the best examples that I could give. If I'm really like a position, like maybe say it's in a base, and I like it as a swing, and I'm like, yeah, I just start buying a position, but it's not really moving in my favor, and it's kind of going flat on the day. It's just kind of a dud. And I'll also maybe consider shorting some spiders or shorting, whatever ETF or sector or ETF that it might be in against that position. And not 100, just not a 1-to-1 ratio, just maybe half a ratio to it, maybe even less. Just something to protect myself. Like I said, I use the sleep method a lot. If I go home and I see myself constantly checking my futures on Bloomberg or just my phone, and then waking up real early in the middle just to check the quotes on everything, let's see where the market's headed, or watching some show on CNBC to see if anybody's recommending anything, I'm clearly doing this all wrong. I don't want to be doing any of that. I want to make this as simple as possible and as stress-free as possible. So I don't trade, like I said, I don't trade big positions, but if I think something is a little iffy or I need to give it a little bit more wiggle room, I might, or if I have a nice gain in something that I don't want to give up because it might still have potential upside, I'll throw out a small little hedge against it in a sector or index ETF.
Okay, Brett, here's a question for you. Brett, are you watching the futures or ETFs?
What I'm tracking during the day is I'm watching these relationships. I watch the futures markets because a lot of the patterns that I'm looking at, these are 24-hour markets. And when you're looking at an ETF, let's say it trades on the AMX or on the NYSE, you're going to get your data cut off at 7 o'clock at night. It's not going to come back on until 3 or 4 in the morning, and you're not going to see what happens. If you're watching the gold market, that runs all over the place in the middle of the night. And the euro, obviously, currency markets are 24 hours. Crude oil is moving all over the place, even equity futures. So the patterns I'm looking at, I'm usually looking at 9, 15, and 60-minute charts, and so I'm tracking trend lines and relationships between swing points. And ETFs, I just don't trust that I'm going to get the right points. And the other thing is, I really don't trust that I'm going to be able to interpret what a market's doing, because there are a lot of problems with ETFs. And I go over this really in depth in the webinar about something like, I don't know if you guys have been watching natural gas, but one quick look at the UNG chart versus any of the charts that I posted on the natural gas futures will show you that there's a tremendous difference between what the price of natural gas has actually done over the last few years and what it appears to have done on UNG, because of the problems that UNG has with carrying its futures exposure. And I get into detail about exactly how that works and the mechanics of it. But I'm watching the futures markets.
Okay, the next question is for me, Damon. If interest rates start moving up, at what level might you expect preferreds to be impacted? Well, most of the preferreds I own are bank preferreds that issued the preferreds during the height of the financial crisis, so the yields on them are actually pretty high. They could come to market probably 200 basis points lower than the preferreds that I own. So I don't really worry about a backup in those particular names. I own some JP Morgan. My second largest position is a Citigroup preferred that actually has a fixed to float feature. So after, I think, 2015, it starts to float with LIBOR, I think 3-month LIBOR plus, I think, 560 basis points or something like that. So there is the ability to buy paper that has floating rate features that will actually rise once interest rates start to move higher. However, I really am not that concerned about it on a lot of the names I own. I have noticed that new issuance has been coming in at pretty low rates, and I do have some concern that some of the new paper that's hitting the market, especially over the past month to 6 weeks, will back up if interest rates start to rise. So I'm staying away from those. I have those on my radar for trading opportunities, because a lot of times these things will, once the IPO, the preferred IPO, if it's a $25 par IPO, rates start to run up a little bit. Once it breaks to $25, you might see a flush down to $23.50 or so. And if it's a decent credit, decent yield, I'll step in there and try to ride it back up to $24.50, $25, trading a fair amount of size on it. So that's my long answer to a short question. Okay, so the next question is, when you put a stop order, how do you know you should use previous day low, opening low, support line, or moving average like the 20-day, 50-day, or 200-day?
This is Scott again, Blue Chip. Well, first and foremost, I go off of my my risk models that I have. If I'm usually 1%, if I'm trading like a $70, $80 stock, 1% would be 75. I usually round up and give it some room, like I said earlier. I like to give wiggle room to everything. So I look at $1 risk for mostly everything, regardless if that's the previous day's low or high or moving average. And I base it off of that. The professionals in this game, they know the stops are above the previous day's high and below the previous day's lows. They know they're at key moving averages. More often than not, you get to see those get triggered and then reverse. So I tend not to put them anywhere near there. Like I said, I try to go off of just my risk assessment first, based upon the capital I committed. What was they said, which one do you use? Is that the question? I missed. I don't know if I answered it. How do you know where you should use? Again, it's more about, when those. I wouldn't actually say which one to use. Like I said, I use about $1 for most of my stops. When price gets to those levels, I want to see the reaction. If price takes out a previous day's low and just goes flying through it, and there's no signs of reversing or no signs of buying, and we're still, the S&P is still not even near a key level or support area, well then yeah, I might get out earlier than the risk that I had already put on it. I might get out quicker than $1. Rather than waiting for that full dollar to get triggered out. So I kind of use the highs and lows of a day and moving averages more as how does price react to it. Really, I try to stay away from, if a low gets taken out of a day, I want to be taking profits. If a high gets taken out of a day, I want to be taking profits. I really try to avoid putting my stops in those areas. Hopefully that answered the question.
Next question is for Brett.
Go ahead.
Do you take trades in currencies, and if so, do you use the futures or Forex?
I use the futures just because, yeah, and I do. I use the futures, and that's just more habit. That's just what I'm used to. There's really no other reason than that. And I guess what that means is that it's artificially reduced my menu, but my menu's big enough. I could be trading Aussie yen or something, and I just, I think that you need to pick a niche that you feel like you understand well, and for some reason my niche with currencies has just always been thinking about them versus the dollar, and I just kind of try to stay in those relationships. So I generally trade the futures, and I pretty much stick to the euro, the yen, the pound, and the Aussie, with the euro and the yen by far and away in the lead. Okay?
Yeah, I think this is an interesting one that probably all of us can answer. With correlation so high between just about every asset class, how does that fit into or affect the calls you make on individual names? It takes any goofball to make any number of comments to move this correlated market, and therefore whipsawing traders. What or how do you react when one of these head fakes occur? I'll start it off. I depend on InventTrader for that type of information. He looks at the world from a macro perspective and on top of what's going on in Europe, on top of U.S. economic data, knows the history of Fed speakers who've maybe said something in the past, and this could be simply a regurgitation of one of those comments, or it's a new comment. So if there's something that crosses the wire that I'm not familiar with, and I tend to pay attention to individual stories, individual stocks, individual themes, and less in the macro world, I look to InventTrader, and I either talk to him or read a post that he's posting on the site. So he's usually pretty good at following up and giving you guidance into what that information means and how it should impact the market. And his ticker is EVENT, E-V-E-N-T.
I can take a crack at that next.
Okay.
My response would be, the way that I look at news coming in where correlations are concerned is I know what the face value reaction should be. I never try to outthink the market. I never try to figure out, do I understand the meaning of this input from the world better than the markets do or better than some of the biggest fund managers in the world do. I'm not trying to play that game. What I do is I say, oh, this could be potentially like more liquidity. Somebody comes in and says something, we're gonna pump more liquidity into the system. One of the Fed guys says maybe there is another QE coming or something like that. What I do is I know the face value reaction to something like that should be risk assets rip. So I sit there and I watch, and I know that a bunch of people are playing that. And if it looks like that's not going to play out, I get on the other side of it. Because I think that a lot of times the best way to profit from headlines is just to see if they're going to do what they're supposed to do and know that a lot of people who have stops right below their entries betting that it does. And then I just play the unwind if it looks like it's going to fail. That's how I handle those.
This is Blue Chip again. Honestly, I don't follow the news at all. I don't follow headlines. I don't follow econ data or anything else. I'm not a big fund manager trying to push around millions of dollars and trying to establish a position and hold it for the next quarter, hoping earnings are good or anything else like that. I'm a small-sized trader just trying to be consistently profitable and take what I can out of the market when I get it. I have my levels, I have my charts, and everything is visual in front of me. I just look at the reaction to everything. I don't need to know what the actual news was or the cause was. I just look at the reactions and I find levels and I trade them.
And yeah, this is Jim, our growth trader. I find that I have the most success when I completely ignore the news and the direction of the major averages. And the reason why I say that is because the stocks that are in my universe are the high relative strength names. These are the leaders. And they tend to give me a pretty good heads up on sort of where we're about to turn. I'll just give you a quick example of that, where last July in 2011, during the tail end of earnings season, I remember that almost all of the big leaders at the time were rolling over almost simultaneously, and often really on no news, but they were coming under huge distribution. And I remember thinking that this, even though the market was going sideways, this is starting to look ugly. And sure enough, about a week later, we had the August crash. And there have been other times where we're sort of in the depths of a sell-off. We have tons of macro headlines coming across. You can think of a million ways to talk yourself out of the market. And then all of a sudden you see the leaders, the high relative strength leaders lining up, along the highs. And they start to break out. And, sure enough, within a few days, the broad market follows. And so what I've learned over the years is that, the headlines you can always think of ways to second guess yourself when you're looking at the headlines, or whether, you're looking at a lot of the noise that's out there. But with me, if I follow the cues from the real leaders in the market when they start acting as a group, that's the most effective thing for me.
Okay, so we've gone an hour here, so we're going to go ahead and wrap things up. There were a few additional questions submitted, so we will answer those on an individual basis. We'll send you an email. So thanks for your attendance. Really appreciate it. If you have any questions, feel free to contact the sales group or to send us emails at briefingtrader@briefing.com, and we'll be happy to get back with you. Have a good evening.